What's going on, everybody? Welcome to episode 7 of Portfolio Talks. Is your corporation turning into a tax trap? We talked about this in our last episode of the difference of tax filing and tax planning. And one of the problems that we start to see with tax filing is the verbiage of just leave your money inside your corporation, defer, 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 defer. And if you do that, you can invest inside your corporation and everything else is solved. If that is not the case, there becomes many situations where your corporation ends up being a tax trap for you and your money is stuck and you don't know what to do. But don't worry, because you listen to Portfolio Talks and we'll guide you through that decision, how to proactively prevent it. And if you fall into that trap, how can you get yourself out of it? And what are some of the next steps? So if you like the podcast, please do us a favor and give us a like, share, subscribe, all that kind of fun stuff. It really helps us on that front to keep driving the channel forward and prescribing you all the financial planning that you need. So stay tuned. Let's jump into it. Season 3, episode 7, Portfolio Talks.
Hey, getting money is my job. Come and pull up to Portfolio Talks. Hey, paper stacking around the clock. Time to pull up to Portfolio Talks. Yeah. Portfolio Talks. Hey, Portfolio Talks.
All right, we are back and chatting about everyone's favorite topic, taxes. Why not? If you're driving to work or if you're at clinic or at the gym, someone messaged like, yeah, listen to your guys' podcast at the gym. And I thought that was crazy. I don't know many people that get jacked up listening to finances during the workout, but whatever works for you, that is fantastic. But nothing is better than talking about taxes, especially right around this time where you just had the, sticker shock of your tax bill. You're preparing for your corporate year end and you're like, oh man, I don't want to run into this trap. Or maybe you're in some of these Facebook groups and your colleagues are talking about the tax bill or the passive corporate grind. And there's so many different words for the same thing. But essentially what happened is many years ago, the government wanted to kind of play a game of whack-a-mole where every time there's tax planning, the CRA will do some revisions and kind of close that off. And what they did most recently was implementing a tax grind. So if you are building too much wealth inside your corporation and you don't need that on the personal side because you're living below your means or you're earning such a significant income, it used to be fine just leaving the corporation and invested and it was super simple. Just grow that as an unlimited RRSP. However, it has to be a little bit more nuanced and strategic nowadays because the government or CRA is watching your corporation to see if you earn too much passive income, 50,000. And if so, you start to lose your small business tax rate, which is the best thing about having a corporation. So we're going to chat about that today. And as a reminder, if you are in our closed Facebook group, the Doctors of Canada Wealth Forum, we'll link it in the show notes. You can get your questions into our mailbag, which we ask at the end of the episode. So we'll jump into that before we wrap up today. But what we really want to talk about is this about leaving your money inside your corporation and how the instinct is to leave the money in the corp and invest it. And although that's not incorrect, sometimes it's not complete. So we'll chat about that. And then we'll chat about some, small business deduction erosions, tax integration, planning workarounds, and then we'll wrap up with our mailbag. But before we jump into that, Tyson, what is new? Tell the audience.
Well, over the weekend, I only golfed once, unlike someone else on this podcast. And so, we're enjoying the kickoff of the sunny summertime weather. I know we've talked to some of our partners that are in other provinces. Man, they don't have summer yet. I got clients in Nova Scotia and they're saying they can't plant their gardens yet because there's the risk of frost still. And it's usually in June when they do that. And I don't know, we're spoiled. Vancouver weather, we start wearing shorts and flip-flops in May. And I did. And it's pretty good. Nothing to complain about.
That's wild. Actually, before I teed off a couple of days ago, same thing. I was having a call with one of our clients in Calgary, and yeah, she was like, "Yeah, it was just hailing a couple hours ago." I'm like, "Oh, that's crazy." I'm just about to tee off in 20 minutes once we're done this phone call, and it was great. Golfed a couple times. Golf is such a sick sport, but I had a great round yesterday. Shot at 83 for the first time ever, so was super pumped about that. But it was funny. I was sometimes my allergies because there's always like the fake summer than the real summer, and fake summer came, my allergies kind of hit me, and then real summer came, and my allergies were hitting me so bad. Even today, if you're watching on video, you can probably see my eyes are a bit on the puffy side. I'm not crying. I didn't get over crying. It's just my allergies. But yesterday I was standing on top of the ball, getting ready to swing, and my eyes were so watery. I was like just wiping the tears away, and then all right, let me kind of see where the green is and just swing for the fences. So call it luck, call it whatever, but really great week of golf, which is nice. So it's about that time where all these tournaments start coming up too. So if you guys are following us on portfolio planning, you'll probably see us posting a lot more about golf. And We have some great partners, some great charities, some great foundations that we'd love to support with these golf tournaments. So really excited. And yeah, if you guys are around and you want to catch around, let us know. We are always down to golf and connect. So on that note, let's jump into the taxes. So let's start with the first myth. So everyone hears the same thing, like more money in your corporation is always better. It's the best that you can ever do. Don't leave the money on the personal side. Invest on the corporate side. Tyson, why is that? And is that a myth or is it not?
Yeah, and I think it's partially true, like any good myth, right? There's a little bit of truth to it. It evolves over time, and I think it really depends on who you're getting your information from and where they got their information from. If you've been an incorporated professional for 30 years, you've gone through some of these changes, but you might be operating on partially old information. And so when I started working with incorporated professionals, really 2016, 2017, they'd had a bunch of tax rules changes. The big ones at that time, they were coming after the family structure. So you used to be able to be an incorporated professional and you can have your spouse work for the company and, take out the garbage, shredding, check the mail, do stuff. And you could pay them a large salary to do that stuff. You could even pay your kids. They labeled that tax on split income or TOSI, and they aggressively went after that because that was a tax play that professionals used to flow money out of their corporation at a very low tax rate because you're using everyone else's low income level to filter that out. So they got rid of that. Then what everyone started doing was just jamming more money inside the corporation. Like Vishal was saying, it becomes trapped in the corp because they're afraid of tax and they don't know what to do. So you will get some accountants that have a way to do that, and you will get some accountants that only look to give you the lowest tax bill this year, as we've talked about in previous episodes. And I think really working with your financial planning team to determine what are you trying to accomplish, when do you want to accomplish it, and where do you need the money to be? I mean, those are really simple questions that we might have to have long discussions about and then give you a couple of choices because it is choose your own adventure. And we want to make sure that you know which way is going to be the most efficient and which one is going to have the money in the right place at the right time for you.
Yeah, and I think that's the key is strategy that used to work before don't always work, in the future. So something that you heard about from your colleague who's, 10, 15 years ahead of you, although that worked for them and that was great, it doesn't necessarily mean it's going to do the same thing for you. And I think this conversation, this topic is a perfect example, whereas you could just leave your money in your corp and invest in whatever.
Yep.
Now there's a lot of rules around that. So yeah, I mean, I think it's a myth because it's not complete. The strategy is sound. It makes sense. Basically, if you pull the money in the personal side, you're going to be in this marginal tax rate. If you don't, you'll be in this marginal tax rate. So the numbers kind of make sense. And as a reminder, your marginal tax rate is your highest tax rate that your income is in, or your next dollar of income would be taxed at that percentage, as opposed to your average tax rate. But that makes sense and that is sound. However, there's a lot of rules against it. And what we usually find is when we're working with our clients, they've never really been explained the implications of passive income or, hey, this is the plan now, but if we keep on track to this, you'll run into it in like 8 years. And they never heard of that before. So passive income, it is, especially for, our clients, our demographic, your high income earners, and it's almost inevitable that you'll run into this at some point. It's not a every year thing, but at some point, once you start to realize your capital gains or you have some large events that are happening, you kind of run into that situation. And there's some things around that. So let's kind of jump into, I guess, before we jump around the workarounds, maybe it's best to kind of explain that a little bit better about the small business erosion if we want to jump into that. And then we'll talk about tax integration and then we'll go into the workarounds.
Sure, sure. So the way that the small business deduction limit works is that we mostly talk about it from the nice small tax benefit. In BC, it's 11%. So your first $500,000 of earnings get taxed at 11%, which is great. And then everything else above the $500,000 is the general rate, which works out to be 27%. Still, 27%, if you're making $1 million in revenue, the first half's taxed at the small amount, the next half is taxed at the large amount. Not that bad. Where we start to get what's called small business deduction grind is where you have passive, what CRA deems passive investments or anything that's earning income in your corporation that's not the business of doing the business. And so the example that I've heard that I like to use is if you are a company that sold pencils. You manufacture, you distribute, you sell pencils. Anything that's not in alignment with the business of pencils could be considered passive income. So if you also had rental income, if you had investments, if you had GICs, if you had other financial instruments, if you had real estate, all these other things that are not the business of doing the business, it considers itself passive income or AAII. It is, CRA looks at the aggregate amount of investment income that you have, and then they start deducting that from your small business deduction limit at a ratio. And the ratio gets steep pretty quick. Once you reach $150,000 of passive income inside your corporation, then it deletes or wipes out your small business deduction limit, and then you pay tax from dollar at the general rate. So without getting into too many numbers, that's essentially like how you could erase your small business deduction limit.
Yeah, really well said. And I think the pencil one's a great example. And for those in the audience, if you're like an optometrist, for example, you're anything to do with the clinic. So even you're selling dry eye care or eyeglasses, all that kind of stuff, that's active income. If you're a physician, your treatments, if you're a dentist, your treatments, all that stuff is active income. But to Tyson's point, interest income is going to be passive, dividends from portfolio, rental income, foreign investment income, and then 50% of your capital gains, which is always important to note. So it's not the entirety of your capital gains. It's 50% of your capital gains is going to be added onto that. The other 50% is not added to your CDA account. But Tyson kind of alluded to GICs. This is another thing to kind of keep in mind because not all investments are taxed the same way. If you have investments that are taxed as capital gains, it's not that big of a deal because it doesn't really matter until you crystallize or realize those capital gains. So until you sell it. So you could do a buy and hold strategy and just compound that problem later on. Yeah, I got really big gains, but I'll worry about that later. That's fine. But if you have a lot of GICs, that's an example of something that will kick you out a T slip every single year. So even if you have a 5-year GIC and you're not going to realize it 5 years, you're still getting a T slip on the annual basis. So you just want to be careful what you're holding inside your corporation and the implications that can have for you in regards to the small business tax grind. So that's just one thing I want to note about the GICs. And then the other thing is what Tyson said is people are very familiar with the marginal tax rates in the personal side. So once you go over this income threshold, the rest of your income is taxed at this tax bracket. Not many people realize it's the same thing when it comes to your corporation. So Tyson talked about that with the small business tax rate and then the general tax rate. It's not once you go over the 500K of net income, all of a sudden that's gone and you're being taxed in the general rate. It's just the surplus, whatever's dripped over from this cup into this cup. And that's what's going to be taxed in the higher rate. So yeah, we don't want to get too into the numbers, but maybe we'll share graphs and stuff like that in a later episode. But that makes sense. That's the small business deduction and how that works. Tax integration. What about that in regards to the corporation on the personal side? Tax integration, does that relate to kind of what we're talking about today?
We always draw back to tax integration. And a lot of the times it's through our education that it comes up first because somebody has told you or they've seen on social media, if you keep it in your corporation or you put it in a trust or you do some of these things, you're sidestepping tax. Well, CRA has this wonderful word called integration. Essentially, whether you did it personally as a self-employed person or if you do it incorporated as an incorporated professional, they're trying to get to the same amount of tax. Doesn't matter which route you go. There are some efficiencies, and we've talked about these in other episodes. Some of it's timing. Some of it is, like where do you want the money? When do you want it? How do you want it? Those kind of things. But, just keeping all your money in your corporation, you'll pay the small business deduction this year. But when you need to spend the money, can you spend it in a business manner or do you need it on the personal side to spend it? And as Vishal always says, eventually you're going to need your money on the personal side. You're going to wrap up your practice. You're going to sell your company. Something's going to happen. And eventually you're not going to want to work, especially if you're financially successful. Then you're going to need your money on the personal side and you're going to retire and spend the money. So building the pathway to get that out of your corporation in a tax efficient manner makes sense. We're mindful of integration, as is your accounting team most of the time. But the conversation that comes up a lot, and we even did a whole episode on it, is salary versus dividends. Do I pay myself a salary and pay high tax, or do I dividend this money out and pay low tax? The differences is not that much, but the benefits of doing a blend of both. With salary, you get your CPP room, you create RSP contribution room. You're contributing to EI. So if you ever wanted to claim parental leave, mat leave, anything like that, you have those benefits available to you. And then when you're paying dividends out to yourself, you're paying the dividend tax rate. And you even get some of that money back, and it's captured through a mechanism, RDTOH. Same with the investments in your corporation. Your interest is taxed the most, like Vishal had just said. Dividends is taxed a little bit more efficiently. And then capital gains is taxed the most efficiently. And then that aggregate investment income that I talked about, it looks at just the numbers. How much investment income are you earning? Doesn't matter which bucket it is. And then once that number breaches 50,000, it starts to erode your small business deduction limit to when they reach $150,000 of AAII. It grinds your small business deduction tax benefit down to 0%.
Yeah. And I think one thing you said that's key is RDTOH, and that is the reason why I think a lot of accountants aren't too worried about the passive income thing, because like, oh, okay, yeah, sure, like, it'll happen, but once we dividend it out to the personal side, you'll get that tax refund. So you can think of RDTOH, sorry, as like a nominal account, kind of like the CDA. One of those things that just kind of sits in your account. So as you are accruing the dividends, you'll get that refundable portion. AMT works the same way as well. That kind of sits there, and then you get credited back as you kick the money from the corporation to the personal side. However, it's always a timing thing. So you want to make sure, yeah, it's great that that account is there and you have that option, but it's not really a tax filing conversation. Again, it goes back to the tax planning. So knowing that you have that account, it would be on your tax return, so you can see that as well. But what's the plan to use that? I think that's always a good question that you can ask your accountants or your financial planners, is if you do have RDTOH, asking that question, like, what's our plan to use this or recoup this? And I think very quickly you'll find that either you're in a tax filing situation or you're in a tax planning situation, just by simply asking that question. So if you are someone that has an RDTOH on hand, or if you're someone that has AMT, and if you're someone that has AMT, there's a time frame on that. So you want to have that conversation sooner rather than later, but it's definitely worth having that conversation and asking that question. What's the plan with using this? And then you'll find out what kind of situation you're in. So that's great. So we talked about the myth, we talked about the small business deductions, we talked about the general rate versus the small business rate, and now we talked about integration. Let's talk about planning workarounds. And I would love to start with the one that is false that we hear about all the time, and that is a holding company. So we hear this all the time. We'll have clients who aren't at this problem yet, but they're projecting to be at this problem in the next couple of years. And we ask them, okay, are you aware that you're going to be running potentially offside with the passive income rules? And like, oh yeah, we talked about it, and we're just gonna kick our money down to our holding company or open up another company and just, push the investments and stuff down there. And that's it. That's the plan. That doesn't work because you're associated with it. So it really follows the shareholder or the directors of the corporation. So you could have a shell game of 100 different corporations. The only one that's really winning is your accountant and your lawyer, because the fees and the minute books and the work that goes into that, and especially if you're complicating it by pushing money around to all these different companies, then there's a lot more tax work that goes into that. If you are the shareholder, you're sharing that same small business limit and all the implications that come with it. So right off the bat, if your solution is opening up a holding company and just kicking your investments down there, there's benefits of a holding company. This ain't one of them, that you can get around the small business tax grant. That won't work for you. You're just going to still be in this situation with a more complicated tax strategy because you have another corporation, and you're going to have higher accounting fees and lawyer fees on an annual basis, and banking fees because you have to open up another bank account and all that kind of fun stuff. So I don't know, Tyson, if you have anything to jump into there to add on to it before we go into what are the actual proper planning workarounds that we have.
Yeah. Well, I think that I'm a strong believer in tax planning, but tax avoidance is a no-go. I mean, like, you just don't want to do that. There's some general rules of retribution that CRA has that they will use, right? We talked about them with a client file recently. It's like that situation doesn't make any sense. There's something, it's called GAR. It's General Anti-Avoidance Rules. It's basically CRA can, whip out the badge and come and get you anytime if they feel that you're doing things to avoid tax that are illegal. It's a no-go. We don't want to do that. We don't want to put clients in that situation. And if they're close to it, we want to pull them back from the edge and, just like, don't draw a CRA audit unnecessarily. But yeah, you're right. If people have different companies, sometimes are incorporated professionals, are doctors, they have to have a hold co because you don't want to be investing in your medco, in your main medical company. So you do want to have a hold co for those reasons, but it's not an avoidance thing. It doesn't give you super benefits of separating your investments and isolating them. CRA deems everything is related as long as it's related to you and you're a shareholder in those companies. And so there's not a lot of maneuverability. And essentially what they're trying to do is make sure that with that word again, integration is your aggregate investment income across all of your companies is not going to reduce your small business deduction limit. And sometimes people don't realize that. So you have your main business and you're a doctor, right? Most of our audience is doctors. And then your friend wants you to invest in their business and you become a shareholder in their business. Well, now you're actually reducing your small business deduction on your Medco because you're also involved in this other business over here. And so there might be ways you can structure that through your lawyer or through your accountant to isolate you from some of that stuff and you can still be an investor. But you want to have those conversations before you pull the trigger and write those checks just to make sure that you're protecting the integrity of your structure.
Yep. Absolutely. Okay, so let's chat about some of the planning workarounds. So, if someone is either in the area of falling offside with the passive income, or they just want to know, like, hey, I'm earning significantly more than I need on the personal side, so I'll probably run into this situation at some point because I'm not going to just leave my money in cash into a corporation. I'm going to invest it, so this is probably going to be in my future. What are some legitimate planning workarounds for that person, that doctor?
Yeah. I mean, you can have your corporate portfolio be tilted towards capital gains. So it's like long-term growth. You're buying something, you're not trading on it. It also means you can't rebalance your portfolio. 2016, they did away with those rules. You used to be able to use a corporate class mutual funds or ETFs. And instead of a mutual fund trust structure, it's a corporate structure. And the corporation would eat up a lot of the fees and some of the interest. So you're only left with capital gains growth in those vehicles. A lot of companies have gone away with them. They just weren't managed properly. So there's very few good options that are left. However, if you have those, you also have to practice proper investment portfolio techniques, which means that you're going to have to rebalance when certain parts become successful. You want to trim the success and you want to repurchase some of the areas that are future growth. But every time you touch those portfolios, CRA deems that as a deemed disposition. They're going to charge you tax. So it's a gray area. You want to make sure your investment management is done very, very well. Capital gains, though, does mean that you get to defer some of that growth and you may get to choose when to trigger that on certain years and then take years off in between so you recover your small business deduction limit.
Yeah. And as a reminder, your corporation, opening of another corporation is not going to help you solve all that stuff. But I like that buy and hold strategy. That's really good. One thing that I would mention is, all index funds and ETFs are not the same as well. So depending which one you are looking to purchase or buy, obviously we're not going to advise everybody on here, like, hey, buy this one or buy this one. But you don't want to get into a situation where you're buying rebalanced ones that are going to rebalance your portfolio. We have this sometimes where clients will hold investments and we'll look at it, and every year when there's doing rebalancing, it will add some kind of taxable income onto the corporation. And then there's other ETFs that are like market cap ones that will do some adjustments, and sometimes they don't trigger a tax bill. So just making sure that you do your due diligence on the taxation of the investments that you're holding inside your corporation. So people really understand, okay, I should do some research on what am I buying? Or sometimes nowadays, because retail investing is so easy, people don't even do any research. It's just like, I don't know,
No.
I heard this index is good, so I'm just going to buy it, or this ticker is
Yeah.
good. But making sure that you do the due diligence to see what is the taxation, especially if you're holding a large index that gets rebalanced. How often does it get rebalanced? Is that rebalancing actually triggering T slips, or is it just an internal rebalancing and it's not going to trigger any kind of income to your portfolio? You just want to be aware of that one because that can really throw off the timing. And if you're learning anything over the last few episodes, it's proactive tax planning is awesome because you have options and you can plan stuff as opposed to reactive. Once you do your tax filing, you go, oh, wait a minute, like I lost some of my small business limit. That's kind of going to hurt me. You don't want to be in that situation. And I think that's a good segue. Maybe Tyson, I don't know if we want to screen share and kind of go through and just talk through some of the scenarios of, if people partially fall offside with the small business rate or if they're fully offside, just put some numbers to those scenarios.
Sure. Sure. Just as I get ready to share this, on to add to what you were saying is when we have these clients that are very DIY investors, there's lots of tools out there. You can be very successful at it. In a Canadian corporation, they're called CCPCs, right? A Canadian controlled private corporation. You want to be very careful about investing in foreign companies. A lot of the times there's a Canadian version, but if you're buying, Tesla stock and you're buying it through the New York Stock Exchange and not through the Toronto Stock Exchange, or you're buying the Canadian version, the dividends that the company pays, you're only going to receive a portion of them because IRS is going to hold back part of the foreign dividend for a Canadian investor. And so you're not even going to get the full benefit of the dividend, and you might even get a tax bill. So you just want to be careful about what you're holding, where you're holding it, and what the purpose is, which is again why when we work with clients, we bring in professional asset management to look at all of these things to ensure that tax is in the right place, it's growing the right way. And if there's going to be something that's going to happen, we're at least going to be aware of it. And we can see, the warning signs on the side of the road. So we know when to make an adjustment. All right, let's share this one here. That is correct. I had to make sure I don't have like my email and everything else open. All right.
Yeah.
So we had this put together for us. It's just showing you different scenarios. If you have the adjusted aggregate investment income across your company or multiple companies, and you're in scenario A, you're earning $40,000 a year in what's deemed passive income, right? You have a $1 million portfolio, you're earning 4%. $40,000 passively, you still get your full small business deduction limit. Whereas in scenario B, you're earning $80,000 a year in passive income. It's good. You're getting partial small business deduction grind. You've breached the $50,000 limit. You have $30,000 over the limit, and you're starting to reduce your small business deduction threshold. You have $350,000 of small business deduction limit, essentially, is what you're going to be receiving at the small tax rate. Additional tax versus scenario A, you're going to pay an extra $35,000 a year in tax, approximately.
Just a quick
At
note on that
100,
is keep in mind it's not you're having $1 million portfolio. So if you're listening or watching this and you're like, hey, I got $1 million portfolio, I'm screwed. That's not the case. Keep in mind that is what's been triggered or crystallized or realized. So that is,
correct.
if you have like $1 million in GICs, or if you have $1 million in dividends, or if you have a blend of everything and you've also sold some of your capital gains, so you're realizing some of those capital gains, that's what that means. So if you're like, I got $1 million in my corp, I'm toast. That is not true. It's again what's actually being T-slipped out to a corporation. So just want to add that in this. You're not panicking if you're watching.
Very true. Scenario C is in this scenario, it's the worst case of the three. It's really not that bad. It means your portfolio is being successful. You're at $150,000 of passive income. Maybe what you did was you cashed out your investment portfolio. These are your gains, and now you have to pay tax on them. You've totally eliminated your small business deduction limit. You're going to pay an extra $72,000 in tax a year. It's about 50% of your growth. But in the following year, you start a new small business deduction limit campaign inside your taxes. And so it's not the end of the world, but it is something to be aware of, and just looking at how much tax or how much AAII you are earning. So if you have a big corporate investment portfolio, if you have lots of GICs, if you have high interest savings, there are vehicles that are there. And so this is a conversation you want your planning team to have with your accounting team to ensure that we're monitoring this. Doesn't mean we avoid it. It just means we want to know what's happening, try and see around the corner as much as possible so that we can plan for when this happens. What do we do? Maybe we break it up over 2 years. For instance, if your year end is in November, we get these numbers, we kind of have an idea. Maybe September, October, we trigger half of this. And then in December, January of the next tax year for you is we trigger the other half. And so now we're staggering this investment lump sum growth over 2 year ends and, spread out the tax liability and preserve your small business deduction limit. So these are some of the things that we can do tactically to ensure that you are aware and maintaining your small business deduction limit.
Yeah. And like, let's say, for example, we're proactive with it and you're in scenario C and we know that this is going to happen this year. It's one of those things that if you're proactive and we keep, hitting that same point, being proactive as much as possible, maybe one of those situations is we can recover some of that money, or even scenario B, if Tyson mentioned that you're partially in the general rate, is if we could add some T4 income to yourself as a shareholder, you can get a dollar for dollar deduction into your corporation. So maybe that gets rid of that partial part. And some people are like, well, yeah, but now the tax is going to be, because integrated, the tax is going to be on the personal side. But if you have RSP room, then you can leave that money and move it over to your RSP. So instead of just paying tax in the corporate setting, you can use a salary, so get a large deduction. And then sometimes the easiest way to get a large deduction inside your corporation. And then if you have the registered RSP room on the personal side, you can kick that money that otherwise would have gone to tax and put that into your RSP account, and then you're good to go. So that's just one example. There's many of them, but one more example of why being proactive and talking to your planning team is so important. So what you don't want to do is be scared of this and just leave your money in cash inside the corporation, or just never have a corporation, just put it on the personal side. That's not the purpose of this episode. This episode is really just show you that this is a trap that's waiting for you. And if you aren't planning for it, you can create a corporate trap where your money's just stuck there and there's no strategy and you're scared to do anything. Tyson kind of jokingly mentioned it, but scenario C is not the worst thing, because it means that you had a really good portfolio and you have a
Yep.
lot of gains that you're trying to realize and move it around. But there's many different ways we can be around it. You just don't want to be in this situation over and over and over again. And sometimes if you're going to be in situation C, we're like, well, we're here anyways. Let's look at realizing some other unrealized capital gains and things of that type. So a
Correct.
bunch of different scenarios of what we can do, but just knowing what's around the corner is so important. And it's such a disservice for a lot of our doctor clients that we onboard, especially. We've had people in all stages of their careers. Like we have one that's 6 years away from retirement, and she never once heard of this. Like no one's ever told her about this. And there's significant capital gains that are sitting inside the corporation. So just make sure that you're aware that, yes, you're at that stage in your career where you need a corporation because you're spending significantly less than you're earning. So the corporation makes sense. And just know that this is something that will probably affect you. Even if it's not scenario C affecting you, it is going to affect the way that you're building your portfolio. It's going to affect the decisions you're making of how you're pulling money on the personal side. It does affect you. And sometimes you don't realize why the recommendations are being made to you because they're not contextualized in regards to the passive income problem. So hopefully that gives you some clarity and and some numbers to actually match up with the problem. So not all doom and gloom. There's some good parts about it.
That's right.
I think that's it for today. We had some prescription packed questions, but honestly, I think we answered the vast majority of them while we were going through here. So no point answering them twice. But a lot of the questions we got was asking about RDTOH. Like I've heard about the RDTOH. I have no idea what that is. As a reminder, that's a nominal account number that sits on your account like the AMT credit. So it'll sit in your tax numbers, and then when you kick dividends out onto the personal side, you can recover some of those credits. So that's what RDTOH is. Where you can find it is talk to your accountant, and it'll be on your tax docs and stuff like that as well. And really, a lot of questions were about what to invest in the corporation and how to avoid the passive income. Don't worry about avoiding the passive income. Just plan for the passive income. Avoiding it would be like not investing your money and not trying to treat your corporation like an unlimited RSP, which I think is a large disservice to the corporation. So you want to definitely invest in it. But I think the biggest trap that we see is the GIC thing. I think that's a big one right away. Is we see a lot of clients that have GICs. They don't realize it's getting T-slipped on an annual basis when they're holding it inside the corporation. And then the other one is we see some people hold some investments that rebalance and they get T-slips to the corporation. They didn't know that. And then Tyson nailed one, which is buying the US version of these tickers or these investments. Because we have, again, some clients that are like, well, I'm just going to do the buy and hold strategy. And they'll buy like Tesla, Meta, Nike, whatever inside the corporation, but they're buying the US version, not the Canadian version. So it's pretty easy for the most part to differentiate between the two. Honestly, even the Questrade, the Hive Questrade, usually it pops up. We start typing up, it'll show the Canadian version, like the .c. I forgot what it was .ca. I think at the end of it, or maybe at the front of it. I don't remember now off the top of my head, but it'll show you right away both tickers. So even it's so easy sometimes that they have the little Canadian flag icon. I've seen that
That's
on
right.
some of these platforms as well. So just make sure that you slow down, take a look at it, pick the right one, and then also if you're buying indexes and ETFs and things of that type, just do the due diligence to see how it's going to be taxed. So when there are rebalances, when there are profits, like how is it being taxed to you? Because I'm not saying don't hold it. If it makes sense for you, you can hold it, but that's going to change. Do you hold it inside your personal registered accounts? Do you hold it in your non-registered accounts on the personal side, or you hold it inside your corporation, which is also a non-registered account, but it's taxed differently because it's your corporation. So before we wrap up, Tyson, anything to leave with the audience in regards to their corporation potentially being a tax trap?
Yeah, I mean, I think you nailed a lot of it. Is don't be afraid and don't avoid things. But we want to have these conversations, and the more you talk about it, the more you learn, and you don't have to learn from your own experience, right? You don't have to have bad experiences. We have clients that we've helped fix their scenarios. Your accountant has clients where they've helped fix the scenarios. So I mean, we can learn from other people's mistakes as well, and really start to hone in a strategy. One of the things that you touched on was like GICs, and I think there's a reason to have GICs for short term money where you need capital to deploy and you don't want investment risk. But there's some people that are so adverse to investment risk because they don't know how it works that they become what's called GIC refugees, and their money stays in GICs for decades. What you don't realize is in a corporation, if you're earning 3% on a GIC, the net benefit to you is 1.5%. And currently, as of June of 2026, there's no GICs that are paying 3%. I mean, you're just not getting that. So you're not getting a good rate of return on your cash. It's not keeping pace with the cost of living increases. And we've actually put together a couple of portfolios where they're very, very safe. They're income producing, but they're way more efficient than a GIC. To get the same benefit, you'd have to be earning a 10% rate of return in a GIC compared to some of these tools just because of the efficient rates of which they produce income and how that is taxed in the hands of you, the corporate owner. And so you want to be aware of options that you have so that you can pull on the right levers at the right time. Don't be afraid of tax, just plan for it and know what's going to happen.
Yeah, the days of the COVID GSEs are over. Those were unreal. Again, like 5.5% GSEs. What a world that
Yep.
was. But those days are done. But yeah, to Tyson's point, there it's really about the tax treatment. So sometimes your rate of return is compounded exponentially by the tax treatment of it. So that can sound crazy, like what, a 10% GSE? Like I would never get 10% GSE. That's correct because the GSEs are taxed in a certain way. So if you can change the tax treatment of an investment, that actually lets you get a better net return on that investment as well. So yeah, at the end of the day, you don't want to not hold GSEs. We're not saying that. We're not saying don't invest inside your corporation. We're just saying that there is something you need to be aware of, which is the passive income treatment. As a reminder, all of your active income, so anything to do with you earning that doctor income in whatever way you're earning that doctor income, that's okay. But everything else besides that is going to be really scrutinized against is it passive, is it not? And Tyson mentioned this about GAR or the anti-avoidance rules, but you just want to make sure that you are tax planning, not tax avoiding, because the Syria will come after you hard with penalties and fines and all that kind of stuff. And the burden of proof is on you, not them. So, it's one of those things that you're guilty until proven innocent, which is an odd thing. So I just definitely don't want to fall into that when it comes to CRA. And, especially for a private practice owner and you're trying to grow and expand your business, the one sure way to stop that is having back tax and money owed to the government. Like the lenders are not going to give you any money either. So you just want to make sure that keep the machine that is your wealth, creation moving, and just make sure that this is part of your plan. So hopefully that was a good way to learn about the scary world of tax and passive income and general rates and all that kind of fun stuff. Again, if you have any questions, as a reminder, you can join our closed Facebook group for doctors across Canada. Ask your questions there. In our next episode, you can ask your questions and get them into the mailbag. It might be an episode like this where we answer them as we're going through it anyways, or like our previous episodes, we'll have a separate segment and go through the queue. If you want to get those questions in, join our Facebook group. We post about it prior to our episode going live and recording, and then you can get your questions in and we'll answer it there. So besides that, thanks again. Make sure you share, like, and subscribe, and we'll see you on the next episode of Portfolio Talks.